All right. So as promised by Brent and Matteo, what I want to do in this session is actually dive into how one would actually use microdata to better understand global capital allocation. And I'm going to do so mainly focusing in the context of my joint paper with Brent and Matteo, international currencies and capital allocation. And so Matteo alluded to this idea in his introductory session that kind of one of the most prominent patterns in international macro and international portfolio allocation is this idea of home bias, that investors are overweight their domestic securities. So beginning with French and Paterba and an enormous literature, it's really been about trying to understand why investors are kind of so overweight their own equities. What we do in our work is we're going to use microdata to really dig deeper. We're going to look at basically the composition of international bond investment. And in particular, we're going to establish the importance of currency in shaping global portfolios. So what we're going to argue is that it's really this tendency of investors to buy bonds denominated in their own currency that's going to explain a lot of the patterns of cross-border investment. And so mostly I'm going to focus in this kind of first module of how we can actually use the microdata to establish that fact. And then in the second module, I'm going to walk through the consequences of that, trying to understand how this investor home currency bias is actually going to kind of change the shape of which firms access capital and kind of the benefits of issuing the international currency. And so Brent kind of walked through the kind of aggregate data, the international investment position data, the net foreign asset position data. We start from a microdata set from Morningstar. So if any of you own mutual funds, you might be familiar with Morningstar from the kind of ratings that they put on a mutual fund, 4 or 5 stars. What we use is the data from them, which is basically the individual portfolio holdings, the individual securities that mutual funds around the world own. And so we can cover investors from 10 different developed markets. And actually beginning from the security level, we can go all the way from individual security holdings all the way up to around $33 trillion of wealth of worldwide mutual fund and ETF positions. What's particularly important kind of for us, and I think really as you think of your own research going forward, is kind of the power you have when you begin with a security level data set going for questions in international macro. So let me kind of explain what I mean by that. So the structure of the data and kind of most data sets on portfolio investment, stocks and bonds, there's going to be a security level identifier. In our case, that's the QSIP 9. It's the 9-digit code that basically uniquely identifies a security. You could start with an ISIN or kind of another security level identifier. But the key is that from this individual position, you can kind of recover the kind of macro, macro variables like the country of where security is issued, like you would in the home bias literature. But you can also use it to kind of dig deeper into the other components of investment. So in particular here, I've kind of listed an example QSIP of a 10-year bond issued by the Petrobras International Finance Company. It's a US dollar denominated 10-year bond from January of 2022. And so if you look at the code, what this will give you is basically the first 6 digits here. That's the issuer, something that we're going to talk about a little bit later today. That's not actually going to be the firm. It's going to be the entity actually issuing the security. The issue, the next 2 digits, are basically going to say this is the particular security being issued. Now, what's important about having a security level information is, so the Morningstar data will tell us things like the name of the security, importantly, the market value of what's being owned, and a whole bunch of useful characteristics. But when you begin with a security level information, you can essentially merge in whatever information you'd like. So we're going to focus on currency, but you could also have maturity, industry, the underwriter, the market of issuance, the law of issuance. When you begin like this, you can really kind of dig into what's driving an aggregate pattern. And so let me show you how we do that for one particular aggregate pattern in our work, which is how different is the currency composition of investment that households and mutual funds make when they invest money domestically versus how money is allocated when foreigners invest. And so this is looking at the currency composition of corporate bond investment for, here I've listed 9 developed markets: Australia, Canada, Switzerland, Denmark, the Euro area, Great Britain, Norway, New Zealand, and Sweden. So let's look here at the Canada line here. What this is saying is that when Canadian mutual funds invest domestically, by domestic Canadian corporate debt, over 90% of those securities are actually in Canadian dollars. And you see across the board that when domestic investment of any of these countries are made, it's overwhelmingly in the country's local currency. But here in the blue bars, you can see when foreigners actually invest, say in Canada here, under 10% of the bonds they buy of Canadian firms are actually issued in Canadian dollars. So across the board, when foreigners invest, even in these developed market economies, they overwhelmingly avoid the local currency. Now, there's one huge exception to this, and that's actually going to be the United States, where overwhelmingly when foreign investors buy the bonds issued by American firms, they do so in the US dollar. Now, you can also flip this and look at when investors buy securities abroad, just outside of their country, how much of what they buy is in, say, the dollar or their home currency. So again, if you look at the Canada bar here, what this is saying is that when Canada invests abroad, nearly 50% of what it buys is in US dollars, and then there's going to be another, say, 25% of it that's in Canadian dollars. But very little of that is actually going to be in any third currency. And importantly, this is actually excluding any investment in the United States. So overwhelmingly, when each of these countries goes abroad and it buys a security, it does so either in its own currency or in US dollars. Now, this is the kind of picture, it's difficult to make using aggregate data, but you can kind of get close to it. But right now, everything I've shown you, you can't rule out a story of, well, maybe the composition of foreign and domestic investment is different because of compositional effects. Maybe what it is that foreigners and domestic investors are lending to different sectors, they're lending to different firms. Maybe this isn't actually currency, maybe it's something about the other nature of investment. And so that's where you can really kind of see the power of having the microdata to unpack these aggregate findings. And so in particular, what we do is in order to identify the importance of currency, we're going to ask the question of how much more of a bond does an investor buy issued by the same firm if it's in its own currency, if it's in the investor's own currency, than it would if it was in any other currency. And so what we do is we run a security level regression that basically asks, the left-hand side variable is the share of any given security C. So this is an individual bond that's issued by firm P that's held by investors in country I. And so the kind of currency, the main coefficient we're interested in is this beta. How much more of a security do you own if the security is in the investor's currency? And importantly, we do this with a firm fixed effect. So we're always going to identify this importance of currency using two bonds issued by the same firm. And we can have other kind of security level controls like maturity and coupon. And so what you can see here is that overwhelmingly, there's kind of a huge effect of currency. So if you look at the coefficient for Canada, this is saying that if a security is issued in Canadian dollars, Canada will account for essentially 90% more of the security of the amount outstanding than it would if it were in any other currency. And that's going to be the case, here I only report for the Euro area, Great Britain, and the US, but across the board for our countries, you kind of find this strong home currency bias. Now, again, using the microdata, what you can really do is then say, what else could I have missed at the bond level that could have explained this effect? And so this is kind of where, again, we're beginning with the microdata can really help you. We can kind of do this exact same regression, but split for multi-currency issuers only, financial firms only, non-financial firms, foreign financial firms, foreign non-financial firms. We can look at structured finance, sovereign nationals. We can control for the residency of where a security is issued. We can control for the governing law. And so that's the idea of, we picked some, but you can imagine that each of these characteristics would kind of form the basis of trying to understand an investment portfolio. Now, the other thing we then turn to is say, I began the talk by talking about how this home country bias, how much investors are overweight securities of their own firms. We want to ask how much of that can kind of be explained by home currency bias. How much can currency explain relative to country. And so what we're going to do here is we're going to run a similar regression framework, but we're going to look at 3 different specifications. We're basically going to include, we're going to ask how much of a security does investors own just if the security has been issued by a firm in the investor's country. We're going to say, what if it's issued in the investor's home currency? And what if there's both a home country and home currency? What actually explain this effect? Now, to be clear, in this regression, it's kind of less clean. And the reason for that is we can't have any firm fixed effects because home country here, that's not something that's going to vary within the firm. And I should say, so on the website, we've actually written up kind of a little problem set exercise where you can run a version of this regression using the disaggregated splits that we produced from this data that we put on globalcapitalallocation.com that can basically run through this regression using slightly more aggregated data. Now, when we actually turn to run this regression, what do we find? So the first thing we do is say just how much of the variation in country level portfolios can be understood by just country alone. And you can see that the answer is a lot of it. This is why home bias is a pretty prominent topic of study in international macro. You can see that this one characteristic alone can explain, so for Canada, it can explain 40% of the variation in Canada's entire bond portfolio, just knowing whether or not a security is issued by a Canadian firm. But using the microdata, what you can do is ask the kind of similar question of how much of Canada's portfolio can be explained by just looking at the currency of a security. And here you can see that the orders of magnitude are, the explanatory power is much higher. So knowing just the currency in which a security is issued can explain 92% of Canada's bond market portfolio. Knowing that securities in Canadian dollars is really going to explain how much of it a Canadian owns. Now, in the kind of third set of regressions, what we can do is run both simultaneously. We can ask, well, how much, if you include both a dummy for the country where a security is issued and the currency in which it's issued, where does the variation come from? And you can see that overwhelmingly, kind of the coefficient on currency is maintained and the coefficient on country is strongly attenuated towards 0. And so essentially, conditional on knowing the currency in which a security is issued, knowing the country of the firm that issued it is actually going to give you very little additional information about who owns the security. And so now here I want to pause and kind of take any questions and discuss this. And what I'm going to do in the second part of this module is basically say, okay, now that we kind of shown this investor home currency bias, what is that actually going to mean for the question of who gets capital across countries and around the world?